This is Taking Stock on Bloomberg. I'm Pimm Fox. All right, the negative signs, yes, they're everywhere. Europe teetering on the edge of a debt crisis. In the United States, the major political parties seem unable to decide on ways to reduce the nation's deficit, and that is causing many investors to leave stocks altogether. My next guest, Lincoln Ellis, he is the chief investment strategist at Strategic Financial Group, and he joins us now from Chicago. Lincoln Ellis, good to have you with us here on Bloomberg. All right, you noted today's story about investors losing faith in stocks. Based on your experience recently, have people walked away from the equity market?
You know, it's interesting, Pimm. They really haven't, although we have seen significant outflows of the equity mutual fund complex. Investors that we talk to and investors that we manage money for really haven't. They have begun to sort of shift their focus, and I think your conversation with Charles was really helpful to get people focused on where the opportunities are, both in the United States and on a global basis, and why those make sense at this particular time relative to the other opportunities where they have to invest. So running away, not quite yet. Looking around the markets for different opportunities, absolutely.
Lincoln, if indeed you're seeing these outflows from stock mutual funds, could it be because people just need this money to live and retire?
It's a great question, and in fact, we do see, particularly in the aging demographic, like we're starting to get into the United States, some of that shift will come from, yes, absolutely, the asset allocation modeling. And when you have these moves, some portions of the investing population will, in fact, move to cash or to fixed income. We're a bit concerned, in fact, that people have been chasing that over the course of this last 6 to 8 weeks. But we do think that, in fact, what you're alluding to there could potentially be correct. Either money to live or taking money out of investments to pay down the very hefty amounts of household debt that still remain out there in the U.S. on their balance sheets.
All right, let's turn now to the institutional investor. Are they moving to non-correlated assets? They want assets that don't necessarily move in lockstep with the stock market, or are they content, do you believe, to invest more in equities?
Well, it's interesting. There's a sort of chart recently of the last 5 years that sort of shows when there's a problem anywhere, there seems to be a problem everywhere. So correlations in emerging economies to the developed economies has become quite high. And what we've noticed over the course of the last 8-week period of panic is that, in fact, and Charles alluded to this earlier, people are in fact, selling things that are further out on the tails of the risk complex. You see that in the commodity space, not just in gold and silver, but across the agriculture space. You've gone through almost 2.5, 3 weeks of no up days in the grain markets, although they did close up a little bit today. And so, yes, institutional investors are definitely pulling in risk and raising capital to defend positions either that they're having conviction in the equity space, or you know, if they do in fact, as you put it earlier, think the world is ending, they're you know, piling themselves into treasuries.
Lincoln, is it also because we're nearing, of course, the end of the third quarter, and they've got to show portfolios to their investor base that make the investor feel that they've got the right money manager?
It's interesting. We were talking about that earlier today, in fact, that part of the selling that you saw in the long end of the Treasury curve, as well as part of the rally that you saw in equities, could very much be that. We see that kind of month-end gaming quite often, and it does tend to get amplified at the quarter end. So, yeah, definitely we're seeing a bit of that.
So, Lincoln, what are you telling your clients? Where should they be allocating new capital?
So we've been talking about this really since the summer, since we knew that we would have to be defensive going into the third and fourth quarter, that we would invest in this suit thesis, and that was staples, utilities, industrials, and technologies, particularly on the consumer side. And we would do that on a global basis, and we would look for companies that were yielding higher than the aggregate yield of the S&P 500, and of course, which is not too difficult these days anymore, higher than the 10-year Treasury. So that really produced an environment and a kind of return for investors over the course of the last 6 weeks that has produced much less damage than the broader market.
Lincoln, what about bond holdings? Have you advised anyone to actually sell their fixed income positions?
We have been rotating for the last 2 months, actually, out of the longer duration pieces of our fixed income portfolio. We continue to hold maturities 7 years and in, and we have actually been moving that rotation has produced additional cash on our balance sheets. We haven't really put a lot of new money to work except for on a couple of opportunistic bases. So we do continue to have a bearish tint to our outlook that suggests that new opportunities will be around the corner.
We've got to leave it there. I want to thank you very much, Lincoln Ellis from Strategic Financial Group.